Hi everyone, you're all very welcome to our Friday market recap of the week gone by. I think it's fair to say, if not the volatility last week, it's been one of the most volatile weeks of the year, and we've seen that reflected in pretty much every asset class. This week we had a wide number of central banks from different regions, all giving a very, very hawkish sentiment to the markets. We had Bank of Canada remaining, or the Bank of China, PBOC, remaining neutral. However, simultaneously, almost at the same time, the same day, on Tuesday, we had the Riksbank coming out with a 1% increase in interest rates in Sweden. We've had interest rates increases in the Fed by the FOMC in America. We've had interest rates by the Swiss, by the Bank of England. So a lot of our primary G7 central banks have all looked to adopt a fairly hawkish approach to try and tackle this global inflation that has been taking place for the last year or so. So markets, there hasn't, I don't think there's been an asset class this week that hasn't been affected by the volatility. We're seeing volatility in the FX markets, the euro, the pound, the Swiss franc, the Japanese yen, particularly with the Bank of Japan's monetary intervention that we talked about yesterday. We're seeing it across the board in the likes of the dollar. The gold prices has been considerably choppy, and of course the stock markets. All our indices, all our primary indexes, are all trading lower into obviously the weekly close tonight. Now, of course, the big question is, will we continue to kind of descend and continue to propel that bearish sentiment into the close, or will we start to see a bit of a moderation, a take profit on the selling bias and start to see a neutraling out into the weekend? Also, in other markets, we're seeing volatility in the bonds. We're seeing volatility in the yield section. We only have to look at the 10-year yield on the daily time frame to see that the price action on the 10-year completely ticking higher as well. So it's important to be aware of this volatility, particularly from a cross asset basis. I know with the Alpha Capital Group, we've got many different types of traders: short term, medium term, longer term. So it's all about, I suppose, understanding the underlying fundamentals of these markets as well. For many, they don't look at the fundamentals, but I do definitely think by looking at the fundamentals, it does give you a little bit of a leg up, a little bit of a tool to kind of maximize your returns, maximize, I suppose, your trading plan, your trading strategy, and ultimately get the best out of it. So as we look at the markets today, of course, the dollar is still continuing to go higher. We're literally at 112 this morning. We did pop through it briefly, and we are kind of pulling back underneath ever so slightly at this moment in time. Again, the volatility in the dollar has been so strong this week. We had the initial impulse from last week. We had the chop and volatility off the back of the FOMC on Wednesday, but on a higher time frame perspective, you can just see how the dollar has continued to grind higher. We've continued to churn higher, and the dollar is continuing to remain bullish. So we had that breakout, we had that double tap retest, and the price action has obviously continued to churn higher in line with current sentiment within the markets. Euro dollar has broken through these lows at 98, or sorry, 99, has obviously broken the short-term lows we saw in the middle of the week at 98, and is now in 97 territory. So we've broken way through parity now, and the higher time frames, again, we're still seeing that bearish order flow still continue to play out. Bearish order flow has been consistent through 2022 as that dollar cycle, that dollar urge continues to intensify, and we're still seeing those markets remain very much muted to a stronger dollar. Okay, the trend is your friend. Okay, I know people tend to trade counter trend positions, but it's important to know which way the trend is moving as traders. So at least that way, then you have a kind of a fair idea or a good idea in which way the markets are generally leaning towards. And of course, that break, the retest of 99, and of course, that continuation through 98 onwards is really kind of ominous, I think, for the euro now, particularly as we look at the higher time frames. Like, this is truly significant volatility since we were at the start of the year. Like our beginning of the year, we were very, very modest. We were up here kind of 115s. We're now trading a some 800 points lower since the beginning of the year. So that's a very, very significant move in the dollar, in the euro against the dollar. And of course, it now looks a case like we're going to have a run at these 2001 lows, where the euro dollar was at anywhere between kind of 85 to 90. Okay, would it be surprising that we see price action continue trending higher? We mitigate and we take out this region down here, or at least very least get close to it. At this moment in time, I wouldn't bet against it. I really wouldn't bet against it. And that also brings the idea of cable, right? We look at the cable, we look at the uncertainty in the pound at the minute politically. Obviously, off the back of everything that's going to happen. And then, of course, we're not long past Brexit. We're only a couple of years over Brexit. And of course, the looming effects that that's going to have. So the pound at the minute is also struggling. We're continuing to make new lows. And if anything, it's probably even more bearish than the euro at the minute, as we see the cable decline. I suppose if we break through the 110s, all of a sudden 105s and one is going to be kind of a serious considerated area. I think 107 to 110 is probably a likely area for the cable now at this point. But of course, we do have to be open-minded to the cycles that's currently at play in these markets. Markets tend to move in cycles. We've yearly cycles, we've quarterly cycles, monthly cycles, all the way down to the shorter time frames. And I suppose as traders, we have to be able to identify that, being able to reconcile that, and then of course being able to find those opportunities and being able to trade that way as well. But even on a short-term perspective, where we were last week, of course, we thought that might be a little bit of a bottom here around 115. Absolutely not. We continue descending lower, continue taking out lows. And of course, this week, the cable has continued to decline through. And since obviously I suppose, volatility that we saw last week, so that was last Tuesday's CPI print, we have gone from 117, almost 118, all the way back into sub 112. So that's a 550, almost 600 point move in the cable in a week and a half. So again, showing the volatility is there in the markets. The sentiment is still very, very much bearish. So it's just important to be obviously recognizing of that. Now, I suppose from a short-term perspective, we're starting to see the yen decouple. Okay, so this movement of the yen in terms of this longer run bearish dollar, weaker yen play off of lack of Bank of Japan movement, or I suppose anything in terms of kind of strengthening the currency. And of course, this week we've seen the Japanese yen ultimately starting to intervene now. We had that massive runoff earlier yesterday. Of course, we had that massive 500-600 point runoff. We're now getting a little bit of a retrace. So you tend to have, broadly speaking, when I look at price action as a trader, you tend to look at structure. You tend to look at sentiment. Yeah, absolutely. You tend to be able to look at structure. Now, I suppose from a short-term perspective, we've got a massive consolidation range here. We knew from commentary that the Bank of Japan 144, 145 is their level for intervention. They've actually told us. They've told us on 2 occasions. So I suppose when you know that they're looking to intervene at these levels, well, then it doesn't make trading easier, but it makes us more aware of the underlying potential of things that could happen. And of course, we've seen that here. We've seen the consolidation. We've broken the structure, and now we're flagging back in. So from my perspective, I'm proactively looking at areas around here just to see if there's any, I suppose, again, further continuation of this intervention. So this intervention that initially took place yesterday, we want to see if there's a follow-on to that. We want to see if there's something more significant, because when you look at the weekly charts, so the higher time frame charts, obviously we're seeing this massive, I suppose, wick forming on both sides on the dollar yen this week. But when you look at the higher time frames, you can see where the yen has gone from since the beginning of the year. The beginning of the year, we were trading around kind of 114, 115, and we've gone all the way up to kind of 145, 146 at the highs. That's a 3,000 point move in 9 months. So we talked about the volatility there in the euro dollar and how much it's moved, but also in relevance terms, the Japanese yen has been on a complete tear this year. So it's important to be able to reconcile that. And noting again, cycles. So these markets move in cycles. We're waiting to see what's the intervention. Is there a follow-on? So watching these areas quite interesting, to see if there's any sort of lead on and a kind of addition to that. Moving to gold. Gold obviously also has not been immune to the volatility this week. We've seen a lot of back and forth chop. Obviously the sell-off last week off the back of the CPI print, and of course market orders, market sentiments, order flow, very, very much bearish into this region of interest here. And markets is now in a consolidationary move. So we talked about it earlier in the week, 1650, 1680 seem to be kind of the rough approximation of the range. We still remain, broadly speaking, still in that area. Okay, so you can see it there very, very quickly. 1659 bodies, 1654 wicks. And of course, we have a wick into 1688 and bodies at 1681. So this kind of $35 range at this moment in time seems to be where gold is looking at. And of course, if the yields continue to take up, we talked about the correlations within markets. If the treasury yields continue to tick higher, that is also going to add a lot more pressure to the gold prices, because we know gold and the treasury yields are normally inversely correlated. So if you're looking at buying gold, keep an eye on that treasury yield, because the inversions tend to remain, and these inversions have been in the markets for decades. Okay, so it's not something that I'm just coming up with now. It's completely random or brand new. They have been kind of a rule of thumb for decades. So I think it's just important to be aware of that. Of course, moving across to the indices now, we're seeing the order flow very, very clear. This was obviously the sell-off from Wednesday's FOMC. Now, we had chop, and I suppose from a volatility perspective, this was the volatility of the FOMC. We took the lows, we took the highs and the liquidity, we stop hunted, we got the order block rejection around 3907, should I say, and we continued moving all the way into this 3750. And of course, for those of you who are watching these videos, I've mentioned this 3750 area. So we've talked about it a few times. We've talked about this level, particularly with the sentiment being as bearish as it has been. And of course, markets now have completely smashed through that. And now it's eyeing the June lows. The June lows now at 3675, 3650 is now becoming the focal point for the S&P. And of course, would we bet against this making this lower at this moment in time? Obviously not, because the Fed on Wednesday, from a fundamental economic perspective, what are they looking at, right? Earlier on in the year, their medium target was kind of 3.5, 3.75 by the end of the year. Now it looks like that's going to be 4.25. So given that they're looking for at least another 1.25 basis points or 1.25% increase in rates, we also have to, the markets and the bigger institutions like your Wall Street banks, etc., Barclays, Goldman Sachs, Morgan Stanley, JP Morgan, they all have to price that in as bigger institutions. And as retail traders, we have to be aware of that. Otherwise, you're selling against the bias, okay, potentially. So I suppose with that as well, obviously wait and see. So S&P's has broken through lows. NASDAQ has also followed suit. So this area around 11.5 has now been taken out. Markets continue to descend lower as we progress to the downside. So very, very clear, very, very ominous selling here in the NASDAQ as well after Wednesday's wick. So Wednesday, we had the volatility across the board, but the higher time frames, very, very clean. Dow Jones has now broken through the 30,000 levels. We talked about it yesterday briefly. 30,000 has now been broken. And now it's a case of, are we going to cement ourselves close back underneath? Because now, the bigger viewpoint now, as we alluded to very, very quickly yesterday, is the pre-COVID highs. This area around 29.5, we're looking to try and take out the June lows on the Dow Jones, which looks like it's very much going to get there. But from our perspective now, this region here becomes a focal point. I've kind of had it in my eyes for pretty much now 6 to 9 months or so. 29.5, it looks like it's going to come. And of course, would it be surprising to see 29.5 and see new lows through here? At this moment in time, as I said, wouldn't bet against it. Okay, we can't bet against this inflation narrative is here to stay. The higher rates by the central banks and the overall bearishness in the stock markets, I believe, is here to stay. So we have to be kind of conscious of that as well. And of course, our colleagues in the UK and of course in Germany with the DAX in Europe, all heading lower as well. Okay, we've broken through this 12.5 level that we focused on this week. The order flow, again, shorter term timeframes, still very bearish. Okay, the order flow there, very, very clear. Lower lows, lower highs, lower lows, lower highs, new lows, flags back up, rejects the order block pretty much to the T, 12.750, 12.80, 12.75, so should I say, and we've continued to grind lower. We've taken out 12.5s now. We're now trading at 12.4, and the market sentiment has now broken through. Okay, so now it's a case of making sure that the weeklies, this weekly close, cements itself through 12.5. If this cements itself through 12.5, well then realistically, we're seeing obviously that the higher trend or the higher time frames perspective still very much leaning to the downside. So your buyers, anyone who's buying this, is doing so as a counter trend position. So it's important to be aware of that. And of course, then last but not least is the FTSE. Okay, the FTSE has been very, very choppy. Traditionally speaking, if you're a retail trader, you'd probably see that as a head and shoulders. Okay. Of course, 75, 76 has been the top. We're now kind of grinding lower again. We've broken through the 72s. I was kind of looking for that. Once we kind of broken through 72s, cleared that out. 71, 75 is also this kind of region here. We're looking at downside continuation back into 7. And some of these calls are playing out quite nicely. So now it's a case of, do we hold 7 and act as a consolidation, or does the FTSE emulate what's happening on the DAX in the higher time frame? So the DAX here, look what's happening up here. Consolidation. Okay, we go sideways 3 or 4 waves higher, rejections. Then of course we have the bottom, and then we've broken through. Okay, so I suppose that's the interesting thing now is, does the FTSE, I suppose, repeat what the DAX done? Okay, does it break through structure? If it breaks through structure, we could very easily be looking at kind of 6.2, 6.4 on the FTSE. So just kind of waiting to see how these weekly candles close as well, I think is important from a longer run perspective. Obviously decoupling as well the shorter term price action, because when you go in at the shorter time frames, like your 1 hour, obviously very, very clear order flow. We had this area here, and we did break through 71.75. This area here, this daily order block area that I've drafted from last week, that we kind of talked about this area here. Rejections. Of course, we rejected it again yesterday. On the 4 hour, we're obviously breaking through. On the 1 hour, of course, as well, we've had that short-term low here at 71.50. We've topped back up. We've rejected this 71.75 on the underside, and we've continued selling off. That's very, very clear selling today. So markets broadly at this moment in time, very, very bearish. Risk is very much to the downside. And I suppose markets now are scrambling for sellers. They're scrambling for risk aversion, and they're looking at the safer place. Hence the reason why the dollar is doing so well as a hedge, albeit at 8.5% inflation globally on average. People would still rather lose 8.5% by holding cash than by holding the S&P. So if you had an S&P ETF tracker, your performance for the year, if we just kind of go back out to the higher time frames, of course the higher time frames even clearer as well. Short-term lower lows, lower highs, longer-term lower highs, retest of lows looks imminent. But if you were to look at the beginning of the year, so from the 3rd of January right through to where we are kind of now, this area here, take the top to kind of where we are currently, we're down a modest 22%. So of course the 8% decline in the buying power of holding cash doesn't seem so unappealing when you see that the broader markets are down kind of 20-25% in some cases. So obviously important to be aware of that as well. All right. So that's where we are for the week. Everyone, of course, any questions, please feel free to reach out as always. And of course, have a great weekend, and we'll see you all next week.